Julie is the Chief Strategy and Innovation Officer at IAG. She's responsible for aligning IAG's customer and corporate strategy and for developing future growth options. She is also on the DARE Advisory Board, and IAG are very much a member of DARE. So without further ado, I would like to ask Julie to speak.
Thank you, and good evening, everybody. And I'll try and be quick so that you can we can get to the Q&A fast. So a slightly different, perhaps, presentation than you've seen before, and I've done some slides, and we'll flick through them carefully. But what I thought I might do is talk to you, and we might switch slides now, talk to you first of all around what insurance is. And when Sally asked me to talk today, I spent a lot of time reflecting and thinking about how to articulate uncertainty in the context of insurance. And in fact, what insurance is, it is pricing uncertainty and removing uncertainty to an extent and risk from the lives of individuals. And if I try and articulate that, what that means, to explain to you a little bit around some of the work that we do and how we think about risk and managing uncertainty on behalf of other people, I wanted to relate a little story for you to sort of close out the day. So what we tend to do in insurance is we travel a lot to understand how different parts of the globe are dealing with areas such as natural perils, modelling and different types of risk and data information. And also because at the end of the day, insurance is about capital. And so what we often do is we trade and we transact capital to balance our risk globally. And so I was at a conference once in the middle of Germany, I'm not sure why, and listening to an economist talk about what they felt insurance was. And it stuck with me. And I think this really goes to the heart of the conversation that we're discussing today. So when we talk about banking or potentially taking out a home loan or a mortgage, this economist described banking as borrowing from your future wealth to make your life better today. So drawing down from the economics that you would, and the wealth that you would have in the future, and you make yourself a little bit poorer to enjoy the trappings of life of being able to buy a house of whatever that is that you want in today's world. Insurance, on the other hand, is the other way around. It's about reducing the wealth of today. So you pay some money from today to make your life better tomorrow in the event that something significant occurs that you would otherwise not be able to afford. And so whilst financial services generally, and banking, insurance, amongst other areas, are covered within financial services, are often treated similarly, they have different approaches to the way they think, or we have different approaches to the way that we think about risk. And so to talk about what insurance is, actually it's the ultimate prediction of uncertainty. We do not produce a tangible product. You only ever see our product if something extreme happens to you, such as a car accident or your home being damaged in some sort of event, or a theft or a burglary. That's the time you interact with our product. So there is a probability about you experiencing our product in the first place. We don't actually make anything. What we deliver to you is a price, and within that price is a quantification of uncertainty across a number of different factors. So today, and particularly in the area that I work, which is around general insurance, so insurance of assets, what we do and where we focus is on predicting the relationship and the interaction between people and the risk associated with people, between the assets with which that people acquire or with which they interact, and where those assets are placed in the natural environment or on our land surface, if I'm being quite specific. And that is how we design our insurance prices and our algorithms. If you think about people, for us, understanding the risk or the uncertainty around people, and I think we've heard previously, if we could estimate and predict everything, then you certainly wouldn't need our product. But the risk around people, where they choose to move, their behaviour, their creditworthiness, their trustworthiness. Those are all factors in an insurance calculation that need to be estimated. If we talk about assets, we need to understand the location. Sorry, I'll come back to that in a second. Sorry, but the construct of those assets. What are those assets made out of? What is the building material? If it's a car, what colour are those assets? Are they visible and easy to see on the road? What kind of technology is embedded within those assets? And that's something important that I'll touch on in a second. And how those assets change over time, how they depreciate in the case of a car, or how they appreciate in the case of a home where people are making modifications and improvements to them all the time. And so those factors form a big part of the way that we price insurance. And then lastly is the most critical piece around defining uncertainty. And this is where a lot of Sally and my conversations have taken place. And this is really around how you predict the natural environment. In insurance contracts, we used to call this part of the equation an act of God. We now call it a natural peril, but specifically for people and the things that they care about, where are they placed in the built environment? Where is the built environment? How does that interact with the natural environment? And how, therefore, can we predict what is going to occur to people and those assets over a period of time that is outside of our control for the most part? So we cannot predict when an earthquake is going to occur. We cannot predict a cyclone. And I will come back to that in a second as well when we talk a little bit around climate change, because there is some predictability and that's changing. But those things are very hard to determine. And so when you set an insurance price, you're looking forward, often in different time horizons. So with people risk, it's around the immediacy of that, of the risk and people's behaviour at that point in time. The more specific you can be about that, the better you can price it. In the natural environment and with natural perils, we're looking at events over a time horizon that may occur in a time span of that or frequency of thousands of years. And we have to determine, in the context of our insurance prices, what the probability of that event happening and the variability around that event in an annual period. And so there is a very high degree of complexity in the way that we determine an insurance price, and it is ever changing. I thought I'd give you a bit of a visual here around the kind of uncertainty that we deal with when trying to predict natural events. So this is some real modelling, but from a while ago, so I'm not giving anything away here. What I'm showing you here is a natural peril, and this is our modelling of a natural peril using 4 different models that are available on the external market that allow you to predict your annual probability of loss. So what this is showing is, in any one year, under the model that is at the top, the dark blue line, there is a 1 in 200 year probability of having a loss of 2.8 billion. But under the model at the light blue line at the bottom, if you believe that model to be true, there is a probability of having a loss of only 500 million. Now, an insurance company predicts it sets its prices on an annual basis, but it needs to carry capital to manage any uncertainty around that risk. So we will collect premium each year, and in the case of IAG, that's roughly, give or take, it's about $10 billion worth of premium we collect annually from our policyholders in Australia and New Zealand. But there is a high chance that that premium is incorrect. And so our regulator requires that we carry capital to protect our policyholders and our organisation from a solvency point of view against the probability, the risk, the uncertainty that exists around setting that annual premium. And the reason for me showing you this slide is to show you the variability in trying to make a decision around what amount of capital should be collected when you have 4 models that show very, very different outcomes. In New Zealand, we're required to carry capital to the 1 in 1,000 year return period. If you look on this example, that would be somewhere between $2 and $5 billion. So you know, a multiple between one model to the other. And that is, you know, the juxtaposition of our role. We're trying to predict what will happen annually, but we're also trying to understand and make sure that we have a clear view of the variability around those outcomes so that we can make sure that our company will survive if one of these events occurs. And in fact, if you have a look historically, the quality and credibility and capability that you have within your organisation and those people with whom you partner to determine these types of outcomes often goes very strongly to your ability to survive when those events occur. And across Australia and across New Zealand, more recently with the earthquakes, a number of insurance companies have not survived on the basis of, say, selecting a model outcome here that perhaps might mean they had to carry less capital one year than perhaps the most severe outcome might suggest. So the more approximate we can be, or the more we can balance those outcomes, the more likely we are to survive when one of these events occurs. So just a quick chat around natural disasters and the forecasting of natural disasters. A few years ago now, we did a piece of work at IAG where we started to try to introduce a discussion around the cost of natural disasters to the Australian economy. And we did quite a lot of research with Deloitte Access Economics to predict how those costs would rise over time. And so what I'm sort of showing you here is back in 2011, or the natural disasters cost the Australian economy about 6.3 billion annually. Now that is without an event occurring, but just the cost of storms and so on cost $6.3 billion annually. We forecast the cost of natural disasters to rise to 23 billion annually by 2050. And in fact, if we look at the numbers today, they're tracking fairly consistently with our predictions. And this sort of situation and this prediction did not take into account the factors of climate change. And I want to talk about that a little bit, because there is the ultimate uncertainty that I feel we as a society need to lean into now. What this showed was how a number of things: increased population, increased asset sizes, land planning that permitted the build of assets and properties within known vulnerable areas. It included the concentration of assets that are being built on coastlines, and also a population shift moving to more northerly states of Australia, where there is a higher probability of natural perils occurring in the first place. So asset concentrations really driving that. What we did was spent a lot of time with the Australian government trying to encourage and support an investment in disaster mitigation. And I know that Hugh spoke to you a little bit earlier around infrastructure. So an interesting fact that we discovered in infrastructure is that we are placing and building infrastructure. What we observe is in natural disaster prone areas, bridges or critical pieces of infrastructure that connect communities will be impacted in events, and we will then rebuild that bridge or that piece of infrastructure in the same place, as if that event is not going to happen again. And yet many of these things, we can understand the vulnerabilities from a natural perils point of view. We also found that perils choices, so understanding exposure to natural perils and therefore the criticality of where key pieces of infrastructure is placed, does not form part of engineering courses and is not a critical input in the context of education. And so therefore frequently, and we could avoid significant elements of uncertainty but those types of assessments aren't done. So often you do come back and have a conversation about raising a dam wall or changing, a system, or improving the resilience of a piece of infrastructure that could have been avoided in the first place. When we did this work and when we talked to the government, what we didn't do was talk about climate change. Today, that's a much more accepted topic, but it was only a couple of years ago that the word debate was dropped from the title of climate change. Whenever climate change was discussed, it was the climate change debate. I think we can say there's no debate now. And if you think about an extrapolation of these types of predictions and the impact of climate on what these numbers might look like, it's quite horrifying. And we've just done a piece of research looking at the impact of climate on our assets, on assets of Australians. And there's quite a few pretty interesting predictions that are coming through that is really important that we start to embed in thinking about the choices we make as a country. And so just to give you a couple of examples, we would predict, and some of this is fairly obvious, but we would predict around the area of natural perils an increased frequency of cyclones tracking further south towards more populated areas like Brisbane and southeast Queensland. So perhaps not as extreme frequency, but much more significant and extreme events hitting populous areas, and therefore significantly increasing costs to the community and the safety of lives. We would predict much more intense short duration rainfall, and that will increase everywhere across Australia. So whilst it might not be long systems of La Nina type rain, such as perhaps we're experiencing now, we're going to see much more frequency of east coast lows, of frequent flooding in urban areas and small river catchments. And so therefore, again, land planning and the choice and use of systems, river systems and so on, really critical. We would expect hail to increase from 2 to 4 centimetres in diameter to beyond 5 centimetres in diameter. Now, and to be much stronger, and that to happen particularly around regions such as the Hunter Valley and northern New South Wales. We expect bushfire risk, as we've observed over the last season, to increase in all locations nationally. And as we know, bushfire is the most significant cause of loss of life from natural perils point of view in Australia. And of course, sea level rise. So if you think about what this graph shows, which is the rise of urbanisation and a shift towards coastal living, and you conflagrate that with a rising sea, we are making choices as a community, and we're making choices as a government that is putting our people and our assets, creating greater uncertainty and more risk around the safety and security of our people and our assets. And so this is what we spend a lot of time in insurance modelling, and why the role of the scientific community and the changing nature of our ability to understand data is so critical. And it's why we're so excited about, the work that we're doing with Sally and the team and what it's set up to do. So if we have a look today, and we've heard a lot about it over the last couple of talks. If we have a look today about what is different, so first of all, I think there are two really critical things that I think make a fundamental difference to our ability to understand risk and manage uncertainty going forward. And you heard in the last talk, of course, there's complexity that comes with that, and creating a whole system is critically important, and I wholeheartedly agree with that. At the same time, there are advances occurring that allow us to understand, reduce and manage our own risk in a way that we've never been able to do before. So this is an example for you. So first of all, and those two things are the relationship between science and scientific knowledge, understanding and research, and data. And of course they go hand in hand. However, data is changing in a very different way. So I just want to show you this picture here, and you might think it's a map. If any of you used to use one in a vehicle before we had a smartphone, it looks a little bit like a UBS map. What this is 1 day of data that we've picked up from an application that we have that we share with our customers called Safer Journeys, where you can download an app in your car and you put a telematics device in your vehicle. And if you have a car accident, we will be able to detect that in real time and send emergency services to you if you need support, or help guide you through and make a real-time claim on the spot in the event that you have a car accident. So if any of you want to download Safer Journeys, I'll encourage you to do that. That wasn't a plug, but it feels like it actually while I'm saying it. But what this is 1 day of data that we've picked up from that information, and it essentially maps the entire road system of Sydney in one day's worth of data. And that is what is fundamentally, and what's most exciting about what's happening in the world now, as you've heard all day, changing our understanding of risk and helping us quantify and manage it in a fundamentally different way than we might have been able to do before. So if you think back to the first slide, which talked about the relationship between people, their assets, and the location of those assets, ultimately location data is some of the most critical data that we can find, because it tells us where our customers are, what they're doing, and what risk they are exposed to, so that we can help better protect them, if that makes sense. So in the past, we would have priced an insurance contract looking backwards at what claims a customer had, the local area that they lived in, what experiences had happened in those local areas. And we would have done a pricing calculation based on the past and what had happened before. The more that we lean into the world of science and the use of data, including real-time data and unstructured data that tells us about behaviour and usage and location, the more we can think about predicting forward, managing that uncertainty, and pricing the risk of tomorrow in a fundamentally different way. And so with that, I will finish and look forward and hand back to you, Sally, and look forward to a conversation with everybody that's online.